first reaction is the theme parks were great, which is absolutely core to the story right now. And they're putting up very good sub growth. I think that there's been some debate about who's the strongest grower in subscription video on demand, and the answer is clear right now. It's Disney. And those two things, I think, are big reliefs for a stock that has frankly been on its heels for much of this year.
It has. I mean, it's off 40% from its highs, even at today's close, after a bounce today. I guess longer term, a question that's been hanging over the whole industry really is how good a business ultimately is streaming going to be. Clearly, every company has to, embrace it, has to make it a priority and spend heavily to get scale there. But do you think it's going to be sufficiently profitable to replace a lot of the earnings from cable and other things that Disney has had in the past that could rebuild the valuation?
Well, I think that's, it's obviously a great question. I think nobody can say with 100% certainty that they know the answer. But I do think you see a couple of things with Disney relative to the peer set that's helpful. One, they have theme parks, they have them at scale. The peer set doesn't. So they'll have that going for them relative to others. The other thing is that they're first into streaming among the big media companies, and they're the biggest scale player among the big media companies with, I'd argue, a comparatively very distinct, powerful, resonant brand. So I think the argument is good that these guys can scale, that they can make money at it, and that it'll be a great complement for TV. So I think that gives you a setup for some earnings growth at Disney that's compelling. The theme parks, the most reliable part of it, and the streaming net of TV, I think skewing positively from what is really kind of a trough level of earnings right now for the investment in streaming.
Any reason to apply a little bit of, I guess, maybe a haircut to expectations for the advertising business or anything else that looks a little more cyclical at this point, given the economic slowdown story that's unfolding?
Well, no doubt. I mean, advertising has been difficult across much of media, not everyone. But, I think that for Disney, you're underexposed in advertising relative to the peer set because their TV networks are overexposed to affiliate fees. And they're underexposed to TV because they have more theme parks. So the mix is really, on a relative basis, on the ad story, friendly for them. Now, you got to caveat this. I mean, if there's a major recession, the theme parks kind of get hit. And, I think that the question right now is what is the macro? If we're kind of skirt around a little bit of a pullback in some of the GDP numbers, but employment is still full, people can still, that are employed can still do things that are fun, like go to theme parks. That's a great setup for Disney. And I think sets them up to bounce nicely against the pullback that we've had here recently.
I think you were looking for a $124 price target. Stock's trading at around $119 right now. Is it something that represents a little bit of a valuation cap, or is it, you think, can it carry higher from there?
Well, look, we'll have to review our model. I mean, the numbers came in, at a good level. But at this point, I think that the theme that this is a company that is doing great in theme parks and has a great setup in streaming, is supportive. Valuation, I think, is certainly something you've got to be more sober about than historically. It's going to be an earnings-driven story. And our take on Disney is that there's a lot to propel the earnings from here. So, going into this earnings call tonight, we still believe that at this moment.
Yeah, and obviously raising prices on the streaming business is a gesture of confidence. We'll see how that goes in terms of the sub-trends. Barton, thank you very much. Appreciate it.
Great, thank you.